Well, it's been quite a ride the last few days, but this morning, good news, the markets are showing some signs of stabilizing. At the time I'm filming this video, the S&P 500 is having a pretty good day. It's up about 1.5%. That's coming at a loss of more than 6% over the past few days. The Dow Jones, it's up about 1% this morning. The Nasdaq is up just under 2%. So we're seeing some good numbers there. Now here at home, after being closed for trading yesterday, the TSX is catching up to yesterday's drops. It's trading down just over 2%. This morning. Now, there are several major U.S. companies that are reporting strong profits this morning, so that also helps. That contributes to the steadiness of the markets. We have Kenvue, which a lot of people don't yet know that name, but it's a spinoff of Johnson & Johnson's fairly recently, known, of course, for Tylenol, for Band-Aids. They're up about 14% this morning due to unexpected earnings, higher than expected, obviously. Uber shares, they're also climbing. They're up about 8% this morning after they beat profit forecasts as well. And a little bit of attention to Japan's market, which has been really leading the headlines the last few days. It has seen its worst loss yesterday since 1987. That's obviously turned around now. The Nikkei 225 is up about 10.2%. That's recovering from a 12.5% drop roughly just the day before. So the recovery in Japan, that's due partly to the Japanese yen stabilizing against the US dollar. And that's really been hearing a lot about that in the news a little the last few days. That's really eased a lot of investor concerns. It is nice to see the market stabilizing today. Some analysts, and myself included, I'm remaining cautious. There's still potential further declines on the agenda due to what we're seeing more evidence of these days of a slowing U.S. economy. And of course, inflation isn't right back to where they want it to be yet. All that said, the U.S. economy is continuing to grow. Recession certainly isn't inevitable. A U.S. federal judge has ruled that Google violated U.S. antitrust laws by maintaining its monopoly in the search business through anti-competitive practices. The decision that was made could actually, and I think probably will, change the way that Americans, the rest of the world, gets online information. It could have an impact on Google's longstanding dominance in this industry. Judge Amit Mehta, he found that Google has violated Section 2 of the Sherman Act by using exclusive contracts with Apple and other mobile ecosystem players to maintain its monopoly in the search business. And the contracts that they were referencing here, they've prevented competition from some of the bigger rivals out there like Microsoft's Bing, DuckDuckGo. Those are a couple that haven't been able to compete fairly because of the alleged anti-competitive nature of what Google has been doing here. So this ruling, it'll probably now lead to some pretty significant changes in how Google offers its search engine that could have an impact on its exclusive deals with these device makers. Monetary fines, of course, will be part of the package, but the primary enforcement focus here will be on altering Google's business practices to foster more healthy competition. Now, the decision here is seen as a landmark antitrust case. It's comparable to past cases that we've seen, like AT&T way back in the day, Standard Oil. Microsoft has gone through rulings similar to this as well. And it emphasizes the illegality of using exclusive contracts to maintain a monopoly. It will set a precedent for future antitrust actions against other major tech companies. The ruling could also influence other ongoing antitrust cases against these tech giants like Apple, Amazon. They have that will impact the Justice Department's case against Live Nation, which is ongoing now as well. And to top it all off, there are concerns that Google's search monopoly could give it an unfair advantage in developing artificial intelligence, something that a lot of attention is being paid to now. And their concerns are that that could potentially lead to them further solidifying its market power. We've seen weaker U.S. labor market data out in the past while, and additional rate cuts are expected now by the Federal Reserve. The markets here in Canada are now anticipating that the Bank of Canada will actually cut interest rates at each of its remaining meetings this year. The U.S. unemployment rate that unexpectedly rose to 4.3%. This has now led to predictions of additional rate cuts by the Federal Reserve. And this is really in sharp contrast to only about a week ago or so. But analysts now from Citigroup, from JP Morgan, they're forecasting 2 50 basis points cuts at the Fed's next two meetings. That's up from just one cut that was predicted about a week or so ago. Now, here at home, Governor Tiff Macklem, he's always insisted that the Bank of Canada's policy operates independently. They make their own decisions. But the two countries here, we have connected economies, U.S., Canada. With this new news, it means that the bank here can be independent, but can comfortably lower borrowing costs that are more in line with the Fed's actions. Now, Canadian bonds, they rallied following the U.S. labor market data. Yields on 5-year notes dropped to their lowest level now since May of 2023. Traders are now fully pricing in 3 more rate cuts by the Bank of Canada this year. That reflects the expectations for ongoing easing. Now, if we see a global bond rally, it also has the potential to increase inflation risks in Canada, particularly in the housing market. Most Canadian fixed mortgages have terms of 5 years or less. So if we see lower yields, that would, of course, lead to reduced mortgage rates. That would potentially at least reignite the home price increases that we've seen. That could then further complicate the inflation outlook. Are you looking for a balanced solution that can offer you both cash flow and potential growth? If so, you might want to consider the BMO Balanced ETF. This is an ETF that invests in a mix of global equity and fixed income ETFs that gives you exposure to a wide range of markets and sectors. The BMO Balanced ETF is professionally managed by BMO Global Asset Management, who will rebalance the portfolio on a quarterly basis to help maintain an optimal asset allocation. By investing in this ETF, you can benefit from the low-cost, diversified nature of indexed ETFs while still enjoying the convenience and the simplicity of a one-ticket solution. So whether you are saving for retirement, a major purchase, or maybe you simply want to grow your wealth, the BMO Balanced ETF can help you achieve your financial goals. Don't miss this opportunity to invest in a balanced and flexible ETF that can adapt to changing market conditions. Learn more about the BMO Balanced ETF today. Visit bmoetfs.com. Now, also on the topic of housing, are you tired of real estate being out of reach? Well, I want to introduce you to Addy. At Addy, they believe that everyone should have a shot at property ownership, no matter your income, your age, or your background. With their platform, you can invest any amount in an institutional-grade commercial real estate, making property ownership a reality for all. Visit Addy today and take your first step towards owning a piece of the future. Sign up at addyinvest.ca and use referral code BEAVIS100 and get a free Addy membership. New data from the Canadian Association of Insolvency and Restructuring Professionals show a significant rise in insolvencies for both Canadian consumers and businesses during the second quarter of the year. Consumer insolvencies, let's start there. They reached a 4-year high, 35,082 filings. That's a 12.4% increase from last year. They cite high living costs, elevated debt servicing costs, and lingering inflationary impacts that have strained Canadian households. This has led to missed debt repayments and increased financial stress. Economic pressures, especially changes in interest rates, have heavily influenced insolvency rates. And it's true that interest rates are declining currently, but the lag effect here, that means that insolvency activity is expected to remain high as Canadians are gradually feeling the financial relief from recent cuts. Now, if we look at business insolvencies, they also saw a pretty big rise here, 1,541 filings, a 41.4% increase from last year. There was, though, a 23.1% decrease from the previous quarter. So that suggests that there's a potential stabilization here. Businesses seem to be adapting to the economic changes. They're managing their finances a little bit more conservatively. So we'll see how that all plays out. Now, in this recent report, the association stresses the importance of seeking professional debt help for individuals who are facing financial difficulties. They say that if you see signs such as missed debt payments, using credit cards for daily expenses, or are feeling constant stress over financial worries, these are indications that the need for professional intervention may be needed to help you get through this, to help you manage your debt and your financial health more effectively. There have been some recent changes in the rules for first-time home buyers I wanted to cover off in this video today too. In a move here that's aimed to helping this particular group, the federal government is now offering 30-year mortgages for those who are purchasing newly built homes. And this change extends the previous 25-year limit. It gives buyers 5 more years to pay off their mortgages. Now, Deputy Prime Minister Chrystia Freeland, she touts this policy as a step forward to restoring generational fairness in the housing market. The extended amortization period here, it's intended to reduce the monthly mortgage payments. It should make it easier for young buyers to afford homes. But there is a twist here, of course, and a lot of mortgage experts, they're cautioning that this policy may not be as beneficial to as many people think due to some restrictions. Penelope Graham from ratehub.ca, she says it's going to be so limited in terms of who this actually applies to when you factor in the price points, the housing types that actually qualify for this, and the type of mortgage you can actually get within that criteria. criteria. Now, there will be a problem, no doubt, in high-cost markets, so cities like Toronto, Vancouver, where many homes exceed the $1 million threshold that applies in this program here. And in these cases, buyers wouldn't be eligible for the insured mortgages. A Toronto mortgage broker, Ron Butler, he says it's almost completely impractical in most of Ontario, most of British Columbia, and certainly Montreal, though it may be more beneficial in the prairies and Atlantic Canada. Under the new rules, the policy will lower monthly payments, but it comes with obviously a significant trade-off here, a longer mortgage. That means you're going to be paying a lot more in interest rates over time. An RBC analysis shows that if you extend a mortgage from 25 to 30 years, it reduces your payments by just over $75 on a $150,000 mortgage, but that results in an additional $20,000 in interest over the loan's life. Ms. Graham, she emphasizes that's an important trade-off that borrowers should be aware of. And the last tidbit of information on this plan, the CMHC, the Canada Housing Mortgage Corporation, will charge a 0.2% insurance premium for these extended mortgages. So when you think of the upfront costs, you have 15, 20% deposit that are often required by builders. There will still be quite a number of young buyers who will still find it challenging, if not impossible, to even utilize this program. And Graham concludes, it remains to be seen how much uptake we're actually going to see on this and whether or not it's actually impactful.